So you know that saying, time in the market beats timing the market? Well, what exactly does that mean, and is this saying true, or is it just something that's, those fairy tales that you hear out there? Well, this is exactly what I'm going to answer today and address for you guys, and we're going to make it clear once and for all with data and stats behind it as to why time in the market beats out timing the market. Guys, if you enjoyed this kind of video, which is slightly different from my usual videos, drop a huge like to let me know so I can create more videos like this to provide more value for you guys, absolutely free. So let's get right into it. Say we have an initial $10,000 investment that we want to throw into the market and just set and forget it and see if this thesis of time in the market actually is better than timing the market. And of course, for this example, say we invest just in the S&P 500, pick your favorite S&P 500 ETF. I've made a few videos on my favorite, which is VOO, so check that out if you haven't. But regardless, the S&P 500 is our benchmark here. Anyway, so now on the screen here, you'll see that the data that we have goes from 1999 to 2018, which is around 20 years. And we can see that over this time period, the S&P 500 has returned an average annual rate of around 5.62%, which has brought our investment from around $10,000 all the way up to nearly $30,000. This is of course assuming that we bought in on the first trading day of 1999, which was January 4th, and held it until the last trading day of 2018 in December. Now, one thing you'll note if you've been in the market for the last year or so was that in December we had a major correction. So if that didn't occur, or if we waited it out till now where that correction is more or less past and stocks have recovered for the most part, this $30,000 investment will most likely be much higher. Nonetheless though, you've pretty much tripled your money here in the span of just 20 years without doing anything, just leaving it in the S&P 500 and just watching it grow and compound year over year. Okay, great. So now say that we miss just the 10 best performing days over this 20-year time period. All of a sudden, that return now drops to 2.01%, and we went from a 5.62% return to a 2.01% return. And this is down from the 5.62% return had we just left our money in the market. This means that our final dollar value that we had from our $10,000 investment is now worth around $15,000 as opposed to $30,000 from before, which essentially cuts our gain in half and costs you 50% profit. So just try to comprehend that over a 20-year time period, just the 10 best trading days contributed to such a large portion of your overall performance with your $10,000 investment. Now moving along, if you missed the best 20 days, all of a sudden now your return is negative 0.33% annually, meaning you would have lost money on your investment. And we ended up here with around $9,400, lower than the $10,000 that we started off with. 20 days in a span of 20 years is very easy to miss if you try to time the market on and off. And this could be for a multitude of reasons. Maybe you're on vacation, maybe you're busy the day the market goes up a lot, maybe you just weren't paying attention, and this could have a huge impact on your returns. Now, if you miss the best 30 days, the return now drops to negative 2.35%, so we'd be losing more money than inflation, which is typically around 2% a year, and clearly would have been better off just leaving this money in a savings account at this point. We're left with around $6,200 on our original investment. At 40 days, the return is now negative 4.2%, and on a $10,000 investment, this means you're down to around $4,200 on your original investment, which is a significant amount of money for most people. At 50 days, the return is now negative 5.87%, meaning that $10,000 is now just about $3,000. And finally, at 60 days, which is just 2 months trading days over 20 years, our return is negative 7.41%, and we would have around $2,100 left in our investment. So it's actually pretty scary because the reality is most of us are going to see this stat and we're going to think, well, that's not going to happen to me. I know that I can time it better than most people, and I know that I can outperform the market or at least match the market. And to that, I'm going to say it's not going to be different. It's going to work out the same over the long term. Timing the market will most likely not work out. It's all here in the stats, it's all proven to you. I've presented the information to you guys, and you can see that time in the market has clearly beaten timing the market. And you can see that just by missing a few days, your performance can be affected drastically, which is why time in the market, just leaving it, letting it ride those ups and downs, is much better over the long term than picking when to buy, say up here, down here, maybe somewhere in between, and trying to position yourself for the best possible entry. Now say even though you're an amazing investor, you go and try to time the market and most of the time you get it correct, say 8 out of 10 times you get it correct, those 2 times could still cost you pretty drastically over the long term. So it may not be worth to go in and spend all that time trying to pick the perfect bottom, trying to pick the perfect top to sell out, and potentially missing out on big gains. The longer your time frame is with your investment, the more your money can compound and grow to much larger amounts. Like in this example, $10,000 growing to $30,000. And if you don't leave this alone and you want to go in and tinker with this, that $30,000 could very easily be $25,000, $20,000, $15,000, or much lower. In fact, a very interesting stat also to go with this is that during this 20-year time period, 6 of the best 10 trading days occurred just 2 weeks after the 10 worst trading days. So if you tried to time this and you waited for that bottom to occur, you would have missed out on some of those gains. Maybe you would have thought, okay, it's going to recover, it's going to bounce back up, go back down, and I'm just going to wait for it to kind of show me that it's on its way back up. That time period that you wait will cost you drastically. In fact, here's a fun exercise. There's a ton of market simulators out there which you can actually go in and use a simulator to buy and sell to pretty much time the market. And this will give you a perfect idea as to how it's nearly impossible to time it 100% of the time and end up with much more money over the long term than if you just left it in there, forgot about it, and then check on your investment 20 years from now. And just remember, if you think you're special, that these hedge funds, people who have millions and millions of dollars, they spend all of this money into the best tools and resources to time the market and try to beat the market. Yet, most of them still underperform the S&P 500 because they think they know the best time to buy and sell, but more often than not, that ends up being the worst time to buy and sell. Now, if you think you're different and you don't have all these millions of dollars, what makes you think that you can actually outperform these hedge funds and the S&P 500? Just some food for thought. If you could come up with a good answer for that, let me know in the comment section down below. But either way, I hope that this data here that I presented you guys sticks with you and explains to you why timing the market is not the best strategy and time in the market is often the best strategy for most investors. But I know most of you watching this video are still going to continue trying to time the market, continue trying to time your entries in stocks, and I'm going to continue getting comments saying I'm waiting for the next recession to buy into the market. And that's completely fine. I mean, there's multiple investment strategies out there. This is just one I wanted to show you guys to show you why it's powerful to just be in the market sometimes and just not worry about all the external noise. But either way, just remember that 10 days could cost you hundreds of % of gain over the long term, and it's really up to you to decide if it's worth taking that risk just to possibly earn a little bit more than if you just left your money in there. Either way, guys, thank you so much for watching. If you enjoy these educational type videos here, not particular stock related videos, let me know in the comment section down below and drop a huge like because that shows me that you guys want to see more videos like this. Thank you for watching. Don't forget to invest positively, and I'll see you in the next one.